If you've spent any amount of time doing retirement planning, you're familiar with what has been anointed as the gold standard of retirement readiness from a financial perspective, the Monte Carlo analysis. If you aren't familiar with the Monte Carlo analysis, don't worry, we'll explain it to some level of detail. In this episode, I would like to suggest that, depending on your personal situation, the Monte Carlo analysis can provide an overly pessimistic view of your retirement readiness and could lead you to unnecessarily postponing your retirement date. I would also like to propose an amendment to the standard Monte Carlo analysis that can factor in additional variables regarding your specific financial situation and spending profile to give you a more pragmatic and accurate forecast of your individual retirement readiness, and hopefully leading you to an earlier retirement date than you thought was previously possible. Hi, my name is Kurt. My wife of 33 plus years and I have been retired for 4.5 years, and we've learned a ton along the way. Prior to retirement, I spent 30 years in the corporate world. If this content looks like it would be helpful to someone else in your life, please share this video and the channel with them. Hitting the like button will always help get this material in front of more people, as YouTube uses all of these signals in order to push this content to the appropriate audience. Also, please remember that I'm not a financial advisor, and this content should be viewed as information only. Monte Carlo analysis is a sophisticated financial simulation technique used to model the probability of different outcomes in retirement planning. It helps us understand the likelihood that your retirement savings will last throughout your lifetime, holding a range of variables such as inflation, withdrawal rates, and life expectancy constant. Instead of using a single fixed rate of return, the Monte Carlo method runs thousands of simulations using random sequences of investment returns. This approach reflects the uncertainty and variability of real-world markets. Retirement is a long-term goal, often spanning 25 to 35 years or more. Over that time, financial markets will rise and fall. A traditional static projection assumes, for example, that a constant 6 to 10% return every year. But that's the one scenario guaranteed not to happen. One year might see 12% return, another might see a negative 10% return. The sequence of returns matters just as much as the average of the returns, especially in the early years of retirement. Monte Carlo analysis accounts for this variability by introducing randomness into the simulation, giving us a more realistic view of the wide variety of what could happen to your portfolio over time. It starts by gathering your current financial information, such as your current portfolio balance, your expected retirement age, your estimated annual spending in retirement, and your expected Social Security and/or pension income. It also looks at what your investment strategy or asset allocation might be, and your life expectancy, or the time horizon of your planning. What your inflation rates assumptions are, and then it begins the simulation process. The software runs 1,000 to 10,000 simulations, each with a different sequence of returns. Each simulation represents a possible life path of your retirement. It tracks whether your portfolio can sustain your lifestyle throughout retirement in each scenario. After running all of the simulations, it calculates the percentage of those where you did not run out of money. For example, a 90% success rate means that in 90% of the scenarios, your retirement plan was sustainable and maintained your feasibility throughout your life. This success rate helps us determine whether your retirement strategy is robust or needs adjustment. Typically, a high success rate, somewhere between 85 and 99%, means your retirement plan is likely sustainable. You might explore whether you can increase spending, retire earlier, or reduce your investment risk. A moderate success rate of 70 to 85% could mean that your plan is probably okay, but might need some minor adjustments, such as cutting back slightly on spending or delaying retirement by a year or two. A low success rate, something below 70%, could mean your current plan may be unsustainable. You'll need to explore changes like saving more now, retiring later, adjusting your spending expectations, or rebalancing your portfolio. As with any model, there are inherent risks to following the results like a lemming. Those risks include garbage in, garbage out, the averaging of averages, reliance on too few variables, etc. But I would like to focus on what I think is one of the most impactful shortcomings on the model. And that's its assumption that all behavior post-retirement is constant and fixed. It assumes that once you establish a given spending profile or budget, that amount will only be adjusted upwards based on inflation. It assumes that all individuals' budgets are created equally and all have the same level of flexibility, meaning none at all. The reality is that based on each individual's financial situation, you may have a lot of flexibility to adjust to bad markets or unfortunate sequence of return realities. Such things as we might postpone large, expensive one-time expenses. We might trim portions of our budget that are more luxuries than necessities. We might adjust the timing of some tax-heavy financial actions, such as Roth conversions, based on the general market conditions. Now, most of us in the early retirement nerd demographic have become overly fixated on being in the top end of that high success rate category, only finding comfort in the high 90% segment, constantly wondering, what would it take to get a true 100% score? Well, I would like to propose an amendment to the standard Monte Carlo analysis that allows us to customize the calculation of our individual circumstance that more accurately reflects our ability and desire to adjust our behavior if the market conditions warrant it. For a base case, I created a fictitious 55-year-old couple looking to retire early at the age of 55 in the Bolden retirement planning software package and gave them a $1,667,000 total financial assets. I established their desired spending plan, including some more luxury items, I'll detail some examples of those shortly, at $5,000 a month. I then ran the Monte Carlo analysis on this base case, and it gave the couple a 91% chance of success. I then modeled the same couple with the same spending after a 25% drawdown in the stock market, which reduced their financial assets to $1,250,000. The fictitious couple now only had a 43% chance of success, according to the Monte Carlo analysis. At this point, most people and their financial advisors would throw up their hands and work for another 5+ years. But all is not lost. I then took a look at their budget to determine what portions, categories or subcategories, of their spending plan was more variable than fixed, or said another way, were more of luxuries than needs, meaning they could be adjusted without dramatically affecting their lives. For this purpose, I looked at my own budget and determined what elements could easily be adjusted. For example, I did not include selling our home and downsizing to save on utilities, insurance, and property taxes, but did include what I believed to be wants more than needs. Those categories included our allowances or spending money, dining out, travel, gift giving, household upgrades, or luxury self-care. Those categories equated to 44% of our own budget, so I applied the same logic to the example couple and determined that they could live on half of the established luxury budget categories in the event of a prolonged bear market of several years. This resulted in the example couple living on $3,900 a month, which was a 22% reduction from their base case spending of $5,000 a month. I then reran the Monte Carlo analysis. Remember, prior to reducing the spending in the very fictitious example I created in the demo Bolden account, the Monte Carlo analysis probability of success was at 43% at the reduced asset value of $1,250,000. After adjusting their monthly spend down 22% to $3,900 per month, the probability of success in the Monte Carlo analysis went up to 95% on that same portfolio of 1.25 million. You could then maintain this reduced level of spending until your Monte Carlo analysis score returned to whatever you determined to be an acceptable level at the increased original spending level. Using these examples, you can conclude that by reducing your luxury spending categories during bear markets, as long as they are a substantial portion of your total overall budget, you can maintain a very high percentage chance of success even though the Monte Carlo score was quite bleak. In closing, I would like to propose that the higher the percentage of your total budget that is in luxury categories, and that you're willing to cut these spend categories if the market dictates, you can enter retirement with a lower percent chance of success and still feel confident. For each 2% of your budget that is adjustable above a 10% standard, you can reliably live on a 1% lower Monte Carlo score than you would have found acceptable prior to any analysis. For example, if you used to think that only 95% was acceptable, but careful analysis determines that a full 40% of your budget is adjustable, then you could feel confident that an 80% Monte Carlo score is acceptable. Note, you must be willing to reduce the spending in these adjustable categories when the market dictates. Well, that's all I have for today's content, but please stay tuned for more riveting content as I ramp up this channel. Thanks for stopping by, and keep on leveling up.